everyone, and welcome to Long Options. My name is Rachel Deschelle. I'm a Senior Manager of Trading Services and your newest coach here on Schwab Coaching. I am joined in the chat by Brent Moores. I see Brent already put our X handles in there. Please follow us on X, Brent Moores CS, Rachel CS. We post a lot of ideas, charts, trade ideas. And please subscribe to our Trader Talk channel on Schwab Coaching, and please like this video as we go throughout today. Now, today we're going to cover the topic of when it may make sense to exercise your option early. A lot of times it isn't very economical to exercise your option, but we're going to go through a couple scenarios where it may be actually more economical to exercise your option prior to expiration. So let's start with some disclosures here. Very important disclosures that options carry a high level of risk and are not suitable for all investors. Certain requirements must be met to trade options through Schwab. The information that we're going to cover today is for informational and educational purposes only and should not be considered any recommendation or advice. We don't recommend the use of just technical analysis as your sole means of investment research, and there are a few differences between the paper money software and the live trading. So we're going to go through paper money for educational purposes only today. Now, to get into our agenda, we are going to start with a market overview like we always do. We're going to review past trades, and then we're going to discuss some of the concepts of long options, the concepts of price, time, and volatility, and then we'll wrap up with an example trade on our paper money platform. So let's move into charting the market. So the first thing that I want to mention here, I mentioned this before on one of our other webcasts, is just when you're first kind of starting out with charting, especially like on a 1 year or longer time frame, just double check this little wave in the upper right hand corner of your chart. Make sure your chart is set to a log scale. That's a logarithmic scale rather than an arithmetic scale. It's basically going to change your chart to look at percentages of price movement rather than just dollar amount movement like you would have on an arithmetic scale. And that's just strictly because let's say, for example, a $5 move from $5 to $10 is a lot different than a $5 move from 100 to 105 for a stock. So this just gives you a better visual of those percentage moves over time. So just a little charting tip to start out there. But let's start with the Dow Jones Industrial Average. I know we looked last week at this megaphone or broadening pattern that was forming out. We talked a little bit about how it indicates that increase in volatility. We talked a little bit about how they're known for false breakouts. And what do we know? We did see a false breakout there to new highs and then price kind of retreating quite a bit. And today it looks like it's trading below its 10-day simple moving average. And the next level of support here is going to be that 20-day simple moving average here, right around 46,784 there. So just kind of a level to watch here in the Dow. Now let's take a look at the NASDAQ here next. So with the NASDAQ, we had a little bit of a different price pattern here. So we started with that breakaway gap, which was that break above that previous resistance. Then we gapped higher yet again. But then today we're kind of gapping lower. And we're catching support still around that same area on the NASDAQ composite, right around its 10-period simple moving average. And I'm going to zoom in a little bit closer so you can see this candlestick formation that's taking place. It's looking a little bit like a gravestone doji candle where you have the open and close that occur near the low of the day. Obviously, we still have a couple more hours of trading, but a gravestone doji candle can indicate that pause in the trend. It can indicate a bottom in that trend here, which the trend is obviously for the last couple days been down. So it could signal that the NASDAQ is trying to really find its support here and possibly bounce from that level. But if not, we're looking at this rest of this gap to possibly be filled. So that could put us all the way down to around 23,270 or so. And then we have that 20-day simple moving average a little bit lower at that initial breakaway gap level below that last breakaway candle. So a couple levels to watch there on the NASDAQ. Let's look at the S&P 500. So S&P 500, we've had a little bit more of a reversal here. So we had the same thing to kind of start out this break of the trend, which was that breakaway gap again, that break above resistance. We had another gap higher. We made all-time highs. And then we're kind of retracing to this, and we gapped below this initial first gap level that also puts us below that 10-day simple moving average. And then now we're finding support yet again at that initial breakout level. So that really indicates, since this gap was filled in just a matter of a few days, really indicates that that's an exhaustion gap now, just because that filled within less than 2 weeks. So kind of looking there, traders may be looking at that 20-period simple moving average to see if we can hold that breakaway gap level there. And then let's look at another one as well. Let's look at the VIX, the volatility index. Obviously, we're in earnings season. We're having a lot of reports coming out now, and the VIX is elevated close to 19. It's up 10% today, and we can actually see it has made a move in the last couple days above its 20-period simple moving average, as well as above its 10-period simple moving average as well. So that's looking like a little bit of a reversal in the trend there, where it's looking like it's moving up higher, but we'll just kind of have to keep an eye on things as this earnings season progresses, as the government shutdown kind of progresses here. And so just a couple things to keep an eye on. So let's take a look at some past trades that we placed over the last few weeks. I'm going to start with Nike because that was one that we placed just pretty recently. And I'm going to pull up the chart on Nike just to show what we were looking at before. And I'm going to hide some of these moving averages to make the chart a little bit cleaner here. So we talked about how we saw this strong move down in Nike. We saw a little bit of a bounce back, showing that bearish continuation pattern of that bear flag. And then we took an entry right as it broke below that support line of that flag. And we've just rode that wave all the way down now, halfway past that flagpole. So we got a little bit more to go all the way down to possibly that 55.26 area where we put our profit taking area at. And what I did in the meantime, I'll go back to the trade tab. So you can see we're up about $2,100 on that trade. We had 5 contracts, so obviously strong downtrend within a short amount of time. That delta is working in our favor there. If I click on this sell, this will show us some of that OCO order that we had in place for Nike. And we had our downside profit taking level at that condition if it goes that full distance of the flagpole, which is about right over $55, like we just pointed out. And then we had our stop. I think we actually placed that at the 200-day simple moving average. One of those, I just actually changed it yesterday and moved the stop up to actually make it a dollar value. And right now the option's trading at $11.77. I put our stop at $10 just so it can protect our profits since we've already made half that move. Now, another idea that we could always do, now we could always change our OCO order to make this for half the amount of contracts, and then we could take profit on half of our trade there since we do have 5 contracts. But because I moved up our stop, placed a tight stop there, we're going to have that protection in case Nike does move the other way, because it has moved down. Let's count how many days in a row. 1, 2, 3, 4, 5, 6, 7, 8 days in a row. It has traded down. So we've had quite the drawdown there in Nike, and it wouldn't be a bad place to take profits as well. So we have that tight stop in there. Now, the next trade we are going to look at is, let's COF, that is our Capital One Financial. And let's just keep in mind the type of trade that we placed. We entered into the trade. We took a long call, or here we are. We took a long call. We now have 45 days till expiration. And we wanted to trade the bounds of this range. So we took a long call when we saw that close above the high of the low day. And we wanted to ride that all the way up to the top of that range there. Now we're seeing that right now, actually, Capital One Financial is forming a little bit of a flag pattern, possibly, or a pennant pattern in this within this range formation. So that could signal we may see an impending break, possibly to the upside of that potential flag pattern, since that is more of a bullish continuation pattern. So with that, we still have our stop in the trade. I've moved that up as well. Let's take a look at where we have it. Our stop is up at $11. I could make that a tighter stop, actually, so I could move that up again if we'd like. And then to the upside, we have our limit to the upside to take profit should this go to 34.90. So those are our past trades there. And I know today we're kind of taking a look at when it may make sense to possibly exercise a long option. And I think we should start by just kind of saying that it is pretty rare that options do get exercised. In fact, only 7% of options in their totality are actually exercised. 93% of options actually get closed out prior to expiration or actually expire worthless. And the reason why is because if we just kind of look at this example, I'll use Oklo as this example and go to the trade tab. Since we look at intrinsic versus extrinsic value here on the option chain, we know that prior to expiration, we still have quite a bit of extrinsic value, not just the in the money portion of the option, but also the time component value of the option too. So a lot of the times it doesn't make sense to exercise our option early because you'd be paying that premium and you'd be forfeiting all that amount of the premium that's still left in the option. So you're not just forfeiting the intrinsic value, you're also forfeiting the extrinsic value that's left in the option. So in this case, if let's say we're long the 115 strike call here, and we decided to exercise our option prior to expiration. Well, that wouldn't make sense because we would actually be taking that entire, we would lose that entire value of about $20. And that would give us the right to buy Oklo at 115. But the reason why this doesn't make sense is because we could actually just buy Oklo in the open market. So I think a lot of us options traders kind of know that it makes more sense to close out that option prior to expiration, or if we're selling an option, to let it expire worthless. But let's talk about a couple different examples, and I'll show you the first one where it may make sense to consider exercising the option. So using this Oklo example, let's just kind of go back in time and look at a chart of Oklo. So let's just say here that we were looking at this time period over the last year, and I'm going to zoom into this a little bit more. And let's say we watched this downdraft during that February, March, April timeframe where we saw those tariff tantrums taking place. There was a lot of uncertainty, obviously. But we did get a little bit of a signal at the bottom here with this very large bullish engulfing candle that not only engulfed the previous day, but engulfed the previous 2 days of trading. So let's just say hypothetically, so let's kind of look at where the price was then. So midpoint of the candle is probably right around $20. So let's just assume we got in at any price during the day this day. and let's say we were looking at a long-term option. So we wanted to buy a call option on that bullish engulfing, and we wanted to ride it out for months and months. So let's take a look at the trade tab. Let's just say we bought the 19th of December all the way back in April, let's say, for example. So, and let's just say we bought a few contracts of this, and let's say we bought, let's say, for example, the 10 strike call. So we bought an in the money call, and I'm going to change this to volume and open interest so we can kind of see that. Or let's just say we bought the 12 strike call. So we bought a little bit of an in the money call on that day when those lows were made, and we wanted to catch the move up. Well, we've now held that option for so long that it's so deep in the money because Oklo has had quite of a run this year. And now there's barely any contracts in open interest. Maybe we're the only open interest in this contract. We're not seeing any volume in these contracts because they are so deep in the money. And let's just say, for example, I'm going to switch this back to position, intrinsic, extrinsic to show these columns here, which I'll kind of give you a hint. Before this morning when I used this example, the extrinsic value was showing 0. So I'm still going to use this example, even though there's still a little bit of extrinsic value shown there. But in the case where you would have little to no open interest, no volume, so the liquidity is pretty much dried out in this deep in the money option, and let's say that you're seeing no extrinsic value left because it's purely, this option is so far deep in the money that is a purely intrinsic value that it's getting its value from because it's moving dollar for dollar with the stock. So still using this as an example, this is where it may make sense to exercise your option prior to expiration. We can do that with any American style options, which, I mean, US listed stocks like this one are American style, which means you can exercise at any time. It may give us the chance to buy 100 shares at $12 without having to deal with any liquidity concerns or anything like that when there's really low liquidity in this case because the option has moved so far in the money. Most people that have held the option have likely closed out by now, given that we have that low value of open interest. This is kind of that first example of when it would make the most sense to possibly exercise this option, is when this option has moved so far deep in the money that it has nearly 0 liquidity, and this option premium is nearly 100% of an intrinsic value. So that's kind of one example there. Now, I want to kind of cover something else too. Another thing to kind of keep in mind with like exercising your option. You obviously have to have enough cash to cover that exercise. So if I was going to buy 100 shares at $12, that would cost me roughly $1,200 for that exercise. So I would just have to make sure I'd have enough in my account. Then I could turn around and just sell the shares if I wanted to in the open market, where there is a higher amount of liquidity there. So that's kind of the other thing to keep in mind. Now I'm looking at the chat here to see if there is any questions. Yep, and Brent actually covered one of these things. This is a scenario that is not very common. Obviously, I'm using Oklo as an example because it has had quite the move. It's had a massive move in just a matter of 6 months. So if I take the low of this day, which was $17, and move it all the way up to where the price is now, that's 558% move. So that is a massive move in such a short amount of time. So in this case, that's kind of if you were buying, let's say, a longer term option, you had a parabolic move up in the stock, and now your option's deep in the money with low liquidity. Doesn't happen very often, but that would be one example of that as well. Now, let's take a look here at another example of when it may make sense to possibly exercise your option early. And in this case, I'm going to look at the Market Watch tab and go to the calendar and filter for upcoming dividends. So if I just go here, I search for dividend, and then I'm actually using this gear right here to look at a public watch list of the S&P 500 and just scan for all stocks within the S&P 500 that may have an upcoming dividend. And let's just say I want to use this date as an example, and I see IBM there. So I'm going to use IBM as our example. And I'm going to type in IBM on the trade tab. Okay, so let's just say I am looking at IBM, and I see that there's an ex-dividend date coming up on November 10th. And I see that the amount of the dividend is $1.68. Now, something to keep in mind when we are long an option, let's say for this example, we're going to be long a call option. We can obviously participate in the upwards move of this option, just like we would in the upwards move of the long stock. But the major differences of a long call option and a long stock position is kind of like two things. I mean, one of them being you're not entitled to the dividend. So as a long option holder, not entitled to the dividend whatsoever. If you're long the stock through the ex-dividend date, you're obviously entitled that dividend. Another one is voting rights in that case. So in this case, if I see some type of premium where it gives me almost like a deal to possibly exercise my option early and capture that dividend, that may be something I would be looking for as a long call holder. Now I'll show you an example of how. So let's just say I have 10 days left till expiration and I'm holding an option on the 14th of November. And let's just say I'm holding this long option at the 287.50 strike call. Now something I'm going to do is if I'm holding this in the money option on the call side prior to an ex-dividend date, I may take a look at the extrinsic value that's left in my option, because obviously that's the amount of premium that I would be forfeiting should I exercise this option early. Because this option is still in the money, I do have that intrinsic value, but the other part of that option value is that extrinsic value. And if we exercise early, obviously we're giving that value up. So in this case, it's kind of fluctuating a little bit, but it looks like it's $1.33 in this case. So what I may do as a long option holder, holding this long call option, I may actually look at the price of the dividend. And I may compare that price of the dividend to the price or the value of that extrinsic value. And so when I do that, I look at 137 versus 168, and I actually see that that value of the dividend is higher than the extrinsic value here left in my option. So if I had enough cash in my account, and I know this may not be the greatest example, we'll use a lower price stock here on the next one, but I would have to have enough shares or enough cash to cover that exercise, to cover buying 100 shares of IBM at this 287.50. Now let's just suppose that I did. That would give me a motivation to exercise my option early prior to this ex-dividend date to be able to capture that extra premium with that amount of that dividend. And the reason why is because that amount of that dividend is obviously higher than the extrinsic value that we would be forfeiting anyways. So that may be another example, a very important example of where we may consider exercising early, obviously if we had that cash set aside. Now, I know this isn't a short options course. We're here to discuss long options today, but let's just kind of think of the other side of our trade. So the other side of our trade is that short option holder. Let's just say they sold a naked call or they sold a covered call in this case. And let's just say they are also short that 287.50 strike call, well, we know that option sellers can have their option assigned at any time. And obviously, kind of some scenarios that may bake into place are if that option moves further and further in the money, if the expiration date is kind of around the corner, that puts that short option holder at risk of early assignment. But the other thing that definitely puts that short option holder at risk of early assignment is us, who has that premium, who has that right to exercise early, where it makes sense for us to exercise early because of that premium in the dividend. So if I'm that short option holder there, I may want to possibly close out my option early just to take away any bit of that dividend risk, which is what we call it, that ex-dividend risk, that would leave me subject to possibly early assignment prior to this ex-dividend date. So, and obviously, if we're a short option holder, we want to close out that option prior to expiration if we're in the money anyways, or else unless we want to be assigned. But in this case, kind of for that short option holder, you need to kind of be cognizant of that if that dividend amount is greater than the extrinsic value. Now let's go through another example and let's take a look at one. So I see an upcoming ex-dividend day for Ford. So let's use Ford since that's a lower priced example. So let's use Ford here. Okay. So we have a dividend date on November 7th. That dividend amount is 15 cents here. And let's just check the chat here for a second. You don't need to own a stock for a certain time to be entitled to the dividend. No, you just need to own it before that ex-dividend date. And I think I just saw Brent answer that question. You would not actually collect that dividend till the payable date. So if you actually want to see when the payable date will actually be for a particular stocks, you could go to the Market Watch tab. Let's just use that IBM example that we just looked at. So IBM, if I click on that date on the calendar, this will show me actually all the important dates that I need to know for that dividend. So we can see when it was announced, what the amount is, when the record date is, and when the payable date is. So I'm not actually going to get paid that dividend until December 10th. So that's when I'll see that show up in my account. So good question there. And then let's go to the trade tab and let's just kind of use that example of Ford again. So we have that example of the ex-dividend date coming up very soon here. And the dividend amount is 15 cents. So let's just say we are long this option for, let's just take a look at the 13 strike call. Okay. Let's just say we're even long the 13th strike call in this example, or we're going to say we're long the 1250s. Okay, so that 1250, we can obviously see that amount of extrinsic value is less than the amount of dividend. It would make sense possibly to exercise our right early to own those shares before the ex-dividend date. Again, just a reminder that you have to have enough cash set aside for that case there. Now, another thing that we can also kind of keep in mind here, we still have a little bit of extrinsic value left in this out of the money option. That extrinsic is still less than the amount of the dividend, but we would be buying that stock at a higher price than what it's trading right now. So in that case, I mean, that short option holder maybe not too much at risk of early assignment, even though that extrinsic value is less than the amount of the dividend, just because of that price or strike price compared to the price in the open market there. So I see a couple questions in the chat. Do I do leaps? Can we do a leap example? We're going to save that for next week, actually. Today we're going to use another example, and I'm actually going to move to that now with Uber. So Uber had earnings today, and over the last few months, we can obviously see Uber has been trading in this rising channel. So we can see the lower ends of this channel here have been touched 1, 2, 3, 4, 5, 6, almost 7, 8, 9, 10 times on the lower bounds of this channel. We see about 3 to 4 touches on the upside here. And that is, looks like a pretty wide range. It looks like about $11 or so range there that we see from those highs to those lows. And we can see just from the earnings reaction, even though they beat earnings this morning, we actually did see a reaction that placed it below that support of that rising channel. And it had a gap down reaction. I'm going to add a couple other lines on this chart too. Let's just see where the 20 and the 10-day moving averages are. So it looks like that reaction, it actually gapped below both the 10 and the 20 period simple moving average as well, found that support there. So you could kind of argue a couple things. Now, if we're kind of taking the weight of the evidence, whether we'd like to take a bullish trade or a bearish trade here, because obviously that's a nasty reaction, which is kind of building up the bearish evidence, and I'll kind of go through that. We obviously had the gap down. We had it's looking like it's going to be a close below both the 10 and the 20. So we had a cross and a gap below both of those. It looks like it may be a close below those. It broke support of our rising channel. So that's another one. And the other thing too is when we're looking at the trend, we obviously saw that the stock is making higher highs and higher lows throughout this entire time period, which is obviously the definition of an uptrend. But with this latest, the last month or so, we've actually seen lower lows or lower highs kind of take place here in Uber. And now we saw a lower low take place. So that may stack the bearish evidence in this case towards a bearish trade in Uber. In that case, possibly buying a put option for maybe another break or close below that level of support. And let's kind of look at maybe just the flip side of that. Let's look at the bull case of this. So the bull case would be that we have been making higher highs and higher lows. We broke a short-term low here, but this latest low that we haven't yet broken that yet, that next lower low. The other thing is that while we traded below that support line, we are actually trading above that now. And if I zoom in a little bit further, this candlestick pattern that we're seeing now looks a little bit more like a possible hammer candlestick pattern that forms at the lows. And we're seeing that candlestick pattern actually forming right at support, which kind of validates that a little bit more, validates that support level where we are looking at that may indicate that while it traded below here, this may be a valid area where we may catch support and may actually bounce up from here. So there's a couple reasons why you could take the trade in possibly both directions. We went through the bearish evidence first. We went through the bullish evidence second. In this case, I am just going to use the bullish evidence and take a bullish trade in Uber. And with a bounce of this, support line here. And I may want my entry to actually give us a little bit more confirmation of a bounce. And let's maybe say our entry is going to be if we have a 2% move above that support line. So I'm going to look at and see where that lands us. So that support line today was around like 92.51. And I'm going to multiply that by 1.02. That gives me 94.36. So I'm going to write that down. 94.36 94.36 may be our entry to say we are only going to buy a call option if we see that valid bounce of support, that 2% above that support line there. And we may also say that we may want to exit when the stock goes below today's low. So if it went below today's low of, let me see where that price is. Let's just zoom a little bit further. 90.08. So I'm going to write that down. 90.08. So that would be nearly a $4 drop there. So that could be where our exit is. Now let's just kind of talk about the other specifications of the trade with Uber. So because the long-term trend is still intact, and because we saw or possibly seeing that little bounce there, I'm going to give myself a little bit of time to possibly ride out this wave of a bounce to possibly the upper end of that channel there. And we saw with each other bounce, I'm going to just kind of look at the time component. When it went from higher bounds to lower bounds the first time, that took 11 trading days. Now let's look in this case. From this low to this high, the first touch, that took about 10 trading days. And then from this high to this low, that took about 16 trading days. So we have these moves kind of happening within a short amount of time. But since this is a longer term pattern, I still want to give myself a few months in time to let this play out, to not give me really much time decay whatsoever. So I'm going to switch this column set to the Greeks in this case, collapse my sidebar here. And let's just take a look at where we may look to possibly buy a call option. So we talked about little time decay. We're only going to see about 4 to 5 cents in time decay on this option. Another thing we can also kind of keep in mind is because earnings just came out, there's not a lot of uncertainty in this stock anymore. We have a low IV percentile of about 18%, just kind of showing that it's a relatively low IV environment. So if volatility increases, so will the price of our option. And in this case, let's just take a look and let's look for a little bit of intrinsic value here, a little bit of a larger delta, and let's consider buying this 90 strike call option. I see that it has a delta of 65 cents. I also see that there is a lot of open interest in this option. There's a lot of volume in this today. So I'm going to consider buying that option, and I'm going to right click on it, go to buy custom with OCO bracket here. And since this is a pretty liquid option, I'm going to use a market order upon entry here because we talked a little bit about our entry price being based off of the stock price. Now we don't know what price the option is going to be when the stock price hits that price, but because of the level of liquidity here, we can sense that it could be a pretty narrow spread between the bid and the ask. So I'm going to go to the conditional order entry right here to the right hand side, and I'm going to pull this over so you guys can see it. And I'm going to say if Uber is greater than or equal to our 2% move above that trend line, which is we said was 94.36. 94.36. That would give us a confirmed bounce. We're going to hit save. We're going to make that good till canceled. Normally can't do that with market orders, but we can since it's a conditional order there. And then we're going to place our upside maybe to the upper part of that channel. So if it bounces all the way to the upside, or we can even say, even not if it makes it all the way to the upside, but if it finds resistance right around this level where it seems to have kind of came around this zone a couple times, right above those all-time highs, maybe we'll make it a nice round number of 102. So if the price of the stock bounces, rallies to that resistance level right around that 101, 102 zone, and makes its way towards the upper end of that channel, that's where we may take some profit here. So I'm going to use that as a conditional order as well to our upside and say if Uber is greater than or equal to 102. And hit save. And then let's use our downside. We're just going to use, we talked about using kind of the low of this candle to kind of tell us we are wrong in this case of a bounce. So that would still probably give us quite a bit of a tight stop, because that is only about $3 to $4 move to the downside. Let's just use that as our downside target to say, if it goes below, if the price of the stock goes below the low of the candle today, which was 90.08, we want to get out of this trade because that tells us we were wrong. And we may take a trade in the other direction. So if I hit save here, again, reminder that market orders, they fill at the next available price. We don't know what that option price will be. You can definitely use that conditional order entry for maybe a limit offset if you'd like to have more control of the price or some things like that. But since this is just a play account, this is just a trade example, we're just showing one way to place the trade here. So let's go to the confirm and send screen and let's confirm this order here. And I'm actually going to do, since I have the capital in this account, I'm going to do 2 contracts in this case. So I'm going to bump those levels there, lock them in. So I'll do 2 contracts in this case. We mentioned not entering a position more than roughly $6,300 because that was kind of like our 5% value of our account. So I'm going to hit confirm and send. Just double check this, buying 2 contracts. When the price of the stock hits that 2% move above the trend line, if it does have that little bounce, we're going to take profit. Whoops, that one didn't save. Luckily, we double checked our order. So we're going to go back to this menu and go to, what was it? What did we say it was? 102. To the upside, that would put us at all-time highs right above resistance. Hit save. Now I'll go back to confirm and send. Just another grand reminder of why we check our orders and slow down. So we have us taking profit above 102. We have us stopping out our losses, or in this case, using that conditional market order. If we are wrong and price goes below the low of today, makes a new low. And we're going to place this order in our long options account. So I'm going to hit send here on that order. And we are just going to have to wait and see if we do have a rally into the close, because obviously that closing price is most important. So that's what some technicians will be watching there. But this is just one trade idea. Today, we talked through a number of different things. We talked about when it wouldn't make sense to exercise your option. Really, what would be 2 different scenarios of when it may make sense to exercise your option prior to expiration rather than just closing out your option. And then we went through a trade example here, and we'll check in on that next week. So it has been a very busy chat here. So Brent, thank you so much for all your work in the chat. Thank you to each of you for your engagement today and just tuning into this webcast. Please give us a like on this video today. Help the algorithm for your fellow traders. Please subscribe to us on Trader Talks, Schwab Coaching, and please follow Brent and I on X as well. We posted a lot of chart setups like this, trade setups. He is Brent Moore CS. I am Rachel CS. And stay tuned for the webcast that is actually coming up next, which is Getting Started with Technical Analysis with Barb Armstrong. Thank you, traders. Have a good one.